Hey guys, hope everything's going well. You guys know that drill. Smash that like button, subscribe if you haven't, comment down below. Follow me on Instagram at AIH_sports. Follow me on my finance channel at AIH Finance. All right, I'm over at Twitter. This is Henrik Zyberg. I really like his analysis of markets. He's an Elliott Wave guy. Now, I don't know too much about Elliott Wave, but I do follow these guys. So I've been asked, what wave do you think we're in? I'm like, you have to consult the guys that look at the waves on a daily basis. I just follow them. I'm more of a fundamental analyst guy. So he posted Tom McClellan, and he looks at many correlations. What I find quite interesting is that the third year of the presidential term is supposed to be bullish based on data that he's looked at. And the second year, as we've seen, is not that good. And what do we see, right? The market tanked. Now, it doesn't happen right away at the same time, but these are some patterns I'm looking at, okay? It may make sense, the year before the election time. So the government may want to start pumping the economy with money. I mean, they like deficit spending. I'm not a huge fan of deficit spending, but it does pump up the market. Remember 2009, 2010, they put so much liquidity into the market just went crazy. 2020 deficit went crazy. The economy, and stock market boomed. And then last year, they went to deficit spending, but it wasn't as much as 2020. So, and also on top of it, you had higher interest rates. And you had geopolitical tension, which screwed up the inflation situation. That's what I missed, just to be honest. I did expect inflation, but not to that degree. Now, I'm looking at another Elliott Wave guy, Zachary Maines, and he's just looking at cycles. And they believe, the Elliott Wave guys, that we are probably like 1-2 years away from a massive crash. Zachary Maine's boss, Avi Gilbert, thinks that we're going to be headed to a 2-year decade bear market. Now, I do expect the next 1-2 years should be decent, in my opinion. I'm not telling you guys what to do, and these are just my own thoughts, but you're looking at, these Elliott Wave guys think you're going to have a crash going into the not Great Depression, into the 1930s or 2030s. 1930s, we know we had a crash. So we're probably going to see one more high to that, according to the Elliott Wave guys, and then move down. Now, once again, if any data changes, I am open to, changing my view, right? But in my opinion, a lot of cycles that I'm looking at, 2024 is probably going to be a year of big challenge, much, much more than 2022. Okay. Last graph that I want to show you, I look at this frequently because this is what the market is pricing on the Fed funds rate. And once again, what you do is take 100 minus 95.67. So that comes to like what, 4.25 about for the Fed funds rate. That's where we're at, kind of, sort of, between 4.25 and 4.5 from my understanding. And if you look at it, okay, you may see maybe a few more rate hikes in February, but ultimately, or in January and February, some rate hikes, but ultimately, the Fed is looking to pause based on this data, right? These guys are sophisticated traders, and they were pricing in rate hikes last year. And you could see where you see 95.03 in June. So roughly about 5% they're assuming. In July, it's the same and maybe a little lower. And they're looking at November 2023 as the first rate cut. So you're looking at what, 4.75 approximately. So yeah, and then the next rate cut will be in what, probably March of 2024. So we're at a point where the Federal Reserve is not going to be raising interest rates as much. And I think the Federal Reserve is politically motivated to a certain extent. And it's going to be quite interesting. And with the pause, I mean, I've looked at some data. I have to dig it up maybe in another video. Stock markets tend to do well after a pause. And then eventually when they cut too much, then you lose ammunition. I'm not a fan, once again, of pumping money into the system, but I will look at it from an unbiased point of view, right? 2007, 2008, they started cutting rates from 5% to 0%. That crashed the whole system. I mean, you had the crash in the whole system. Now they did crash. I mean, they did lower rates in 2020 to 0, and that actually boomed the economy, or it created a boom. I think it got people involved in assets they shouldn't have been involved with, like high-end real estate, but it is what it is, guys. So I wanted to hear your thoughts on this. Do you expect a bullish year and bullish outcome in 2023 based on what the market participants are saying? It looks like the Fed funds rate is not going to be going substantially higher, and a pause is most likely in summertime, but we shall see it. There is, subject to change of data. Now, the inflation numbers, the rent numbers aren't going higher. They're actually going lower from what I've seen. So it indicates that CPI numbers may be in the favor of the bulls. And while there's inflation, but not too much. All right, guys, let me know what you think. Remember to smash that like button, subscribe if you haven't, comment down below, guys. Thank you. Bye.